What if I told you that one small tax mistake can cost you thousands of dollars, even if you didn't mean to do anything wrong? Every year, millions of Americans miss the tax filing deadline. Some think I'll file next month. Others believe IRS won't notice. But the IRS always notices. In this video, I'll explain IRS penalty for late filing from start to finish. What late filing really means, how IRS penalties are calculated, real-life examples, how to avoid penalties legally, and how to remove penalties if they already exist. Watch till the end, because I'll share a legal IRS penalty relief rule most people never hear about. What is late filing? The IRS requires most taxpayers to file a federal tax return by April 15th each year. You are considered late if you do not file your tax return by the deadline. You file after the deadline without an approved extension. Important difference. Filing a return and paying taxes are two different things. Even if you paid some tax, a late return can still trigger penalties. Types of IRS penalties for late filing. The IRS charges multiple penalties, not just one. 1. Failure to file penalty most severe. This is the largest and most dangerous penalty. Penalty 5% of unpaid tax per month. Maximum 25% of unpaid tax. Example: tax owed $10,000. Filed 5 months late. Penalty $2,500. This penalty alone can destroy your finances if ignored. 2. Failure to pay penalty. If you file your return but don't pay the full tax. Penalty 0.5% per month. Maximum 25%. IRS advice: if you can't pay, file anyway. Filing on time reduces penalties dramatically. 3. Interest on unpaid taxes. In addition to penalties, IRS charges daily interest. Interest rate changes quarterly. Compounds until the balance is paid. Penalties plus interest equals growing debt. 4. Fraud penalty extreme case. If IRS believes you intentionally avoided taxes. Penalty 75% of unpaid tax. Possible criminal charges. This is rare but extremely serious. Real-life penalty calculation. Example: average American worker. Tax owed $5,000. Filed 6 months late. Failure to file penalty. 25% equals $1,250. Failure to pay penalty. 0.5% 6 months equals $150. Interest. Approximately $100 plus. Total extra cost $1,500 plus. It's painful to look at those numbers, isn't it? You essentially handed the government a 30% tip just for missing a deadline. While your logic is spot on, there is a tiny bit of tax math nuance to clarify. The IRS actually reduces the failure to file penalty by the amount of the failure to pay penalty when they overlap. So, while the total is still high, it's slightly less than a simple addition of the two. Here is a breakdown of how that script actually plays out in a real-world scenario. The late tax post-mortem. Scenario: you owe $5,000 and missed the April 15th deadline by 6 months. 1. The failure to file penalty, the big one. This is the punishment for not sending in the paperwork. It's 5% per month, capped at 25%. Calculation: 5,000 times 25% equals $1,250. Note, because you also owe a failure to pay penalty, see below. The IRS reduces this 5% to 4.5% for the months they overlap. Adjusted total $1,125. 2. The failure to pay penalty, the interest one. This is for not sending the check. It's 0.5% per month, capped at 25%. Calculation: 5,000 times 0.5% times 6 tax months. Total $150. 3. IRS interest the moving target. Interest rates fluctuate quarterly. As of early 2026, let's assume a rate of roughly 8% annually, compounded daily. Estimated interest $200 plus interest is charged on the tax and the accumulated penalties. The takeaway: filing 6 months late costs this worker $1,475 in extra fees. That's a high-end laptop or a decent vacation gone just for missing a date. Pro tip: the first time abate. If this is your first time being late in 3 years, you can often call the IRS and ask for administrative waiver first-time penalty abatement. They will often wipe away the penalties, though you'll still have to pay the interest. To dive deeper into the tax math, there are 3 critical layers to understand how the penalties interact, how IRS compounds, and a major policy change happening this year 2026. 1. The overlap rule. The IRS doesn't just stack penalties on top of each other blindly. When you both fail to file and fail to pay, they discount the bigger penalty. The math: normally failure to file is 5% per month. But if you also a failure to pay penalty 0.5%, the IRS reduces the failure to file rate to 4.5%. The result: you still pay a total of 5% per month for 0.5% plus 0.5%, but it's split between the 2 buckets. This lasts for the first 5 months until the failure to file penalty hits its maximum cap of 25%. 2. The interest snowball. Interest is where the bill gets sneaky. Unlike simple interest, the IRS uses daily compounding interest. The rate for the first quarter of 2026, the rate is 7% annually. The snowball effect: interest is charged not just on your $5,000 tax debt, but also on the penalties themselves. Day 1 interest on $5,000. Day 30 interest on $5,000 plus $250 penalty plus previous interest. Stopping the clock: the only way to stop the interest is to pay the balance. Even if you get a penalty waived later, the interest stays until the underlying debt is gone. 3. Big news for 2026: automatic abatement. Starting this 2026 filing season, the IRS has implemented a first-time abate FT automation. How it works: if you have a clean record for the past 3 years, the IRS systems are now designed to automatically waive failure to file and failure to pay penalties. The catch: this only applies to the penalties. You are still legally required to pay the original tax and the accrued interest. File immediately even if you can't pay a dime. Filing stops the 4.5% monthly penalty. The 0.5% paying penalty is 10x cheaper than the filing penalty. Check your transcript since the 2026 automation is new. Log into your irs.gov account to see if the what if you are owed a refund. This surprises most people. If very sorry, you are owed a refund. You file late, no penalty is charged. But if you don't file within 3 years, your refund is forfeited permanently. The IRS keeps your money. Why your refund has an expiration date. 1. The shocking truth: late filing penalties. Usually, most people are terrified of the IRS. They think if they miss April 15th by even a day, a SWAT team of accountants will descend on their house. The reality: the IRS only charges failure to file and failure to pay penalties based on taxes owed. The math: if you owe $0, then 5% of $0 is $0. The surprise: if you are owed a refund, you can technically file your return months or even years late without a single penny in penalties. 2. The catch-20 to the 3-year rule. The IRS is patient, but they aren't your savings account. Under Internal Revenue Code Section 6511, there is a statute of limitations on claiming a refund. The window: you generally have 3 years from the original filing deadline to claim your money. The deadline, for example, for your 2022 taxes due in April 2023. The clock stops in April 2026. The forfeiture if you send that return in 1 day past the 3-year mark. The IRS will process the return, but they will legally keep your refund. They call it excess collections. You call it losing your vacation fund. 3. Why people miss out. Every year, over $1 billion in refunds goes unclaimed. Why? Low earners, people who didn't earn enough to have to file off and don't realize they had taxes withheld or qualify for the Earned Income Tax Credit. Life events, moving, job changes, or health issues can make a tax return feel like a low priority until 3 years have zipped by. Fearsome think filing late will trigger an audit, so they stay hidden, not realizing they are literally donating their check back to the Treasury. 4. The checklist to reclaim your money. If you realize you're owed a refund from 2 years ago, don't wait. Gather records, find your W-2S or 1099s from that specific year. If you lost them, you can request a wage and income transcript from irs.gov. Use the correct forms. You must use the forms for the actual tax year you are filing. For example, use 2020 to forms for 2020 to income. Paper versus digital. Often, very old returns cannot be e-filed and must be mailed. Certified mail is your best friend here. It's your only proof that you beat the 3-year clock. The bottom line: the IRS is happy to take your money if you're late, but they aren't going to chase you down to give it back. If you don't ask for your refund within that 3-year window, it becomes a permanent gift to the US government. The legal basis, Section 6511. The 3-year rule isn't just an IRS policy. It is federal law under Internal Revenue Code Section 6511. It essentially creates two gates you must pass through to get your money. Gate 1, the 3-year rule: you must file the claim within 3 years of the date the return was originally due. Gate 2, the 2-year rule: alternatively, you can claim a refund within 2 years from the date the tax was actually paid, whichever is later. The hidden detail: if you never file a return, the IRS treats your date of payment for withholdings from your paycheck as the original tax deadline, usually April 15th. This means if you don't file, the 3-year clock and the 2-year clock often expire at the exact same time. 2. Why the IRS doesn't charge you a penalty. This is the part that feels like a trap to many. The penalty is a percentage. The failure to file penalty is usually 5% of the unpaid tax for each month it's late. The zero-sum game: if the IRS owes you money, your unpaid tax is $0, therefore the penalty is $0. The result: this gives people a false sense of security. They think, oh, I'm not being charged penalties, so I can just do this whenever I get around to it. By the time they get around to it in year 4, the law has already barred the IRS from cutting the check. What happens if you ignore the IRS? Ignoring IRS notices can lead to it. IRS warning letters: CP 14, CP 501, CP 504. Bank account levies, wage garnishment, tax liens, passport restrictions for large debts, long-term financial stress. The IRS never forgets unpaid taxes. The financial avalanche: penalties and interest. The moment a deadline is missed, the clock starts. Failure to file penalty: this is the big one. 5% of the unpaid taxes for each month or part of a month that a tax return is late, capping at 25%. Failure to pay penalty: 0.5% of the unpaid taxes for each month it remains unpaid. Interest: and like a fixed loan, IRS interest is compounded daily. For 2026, the minimum late filing penalty for a return more than 60 days late has increased to $525, or 100% of the unpaid tax, whichever is smaller. 2. The escalation timeline. The IRS follows a very specific notice cycle before they start taking your things. Initial notices CP14, CP501, CP503. These are the polite reminders. They state what you owe and demand payment. The warning shot CP500 for this is the final notice of intent to levy. It means the IRS is legally preparing to seize your property, state tax refunds, or other assets. The seizure phase. If you reach this point, the IRS no longer needs a court order. They can garnish wages, take a portion of your paycheck before it even hits your bank account. Bank levies freeze your bank account. After 21 days, take the funds. Federal tax liens, a public legal claim against your property, home, car, business that alerts creditors and ruins your ability to get credit. 3. Passport revocation. If your seriously delinquent tax debt exceeds a specific threshold, which is $66,000 for 2026, the IRS can notify the State Department. This can lead to the denial of a new passport or the revocation of your current one. 4. Why they don't forget. The IRS has a 10-year statute of limitations to collect back taxes starting from the date the tax was assessed. While 10 years sounds like a long time to wait it out, the IRS is most aggressive in the final years of that window. Note certain actions, like filing for bankruptcy or an offer in compromise, actually pause the 10-year clock, extending the time they have to chase you. The good news: the IRS is surprisingly easy to work with if you talk to them. They offer installment agreements, payment plans, and currently not collectible status if you truly cannot afford to pay. The ghost tax return SFR. If you don't file, the IRS will eventually do it for you. This is called a substitute for return SFR. The catch: the IRS will only use the income information they have from W-2s and 1099s. They will not include your deductions, business expenses, or dependents. The result: you end up with a tax bill that is significantly higher than what you actually owe. 2. Lien versus levy. Understanding the difference. People often confuse these, but they are very different stages of the collection game. The lien, the warning: a federal tax lien is a legal claim against your property. It doesn't take your house yet, but it tells the world and your bank that the IRS gets paid first if you sell anything. It effectively freezes your ability to get a loan or refinance. The levy, the actual levy, is when they actually take the asset. They can levy your bank account, the amount owed, or levy your wages, take a chunk of your paycheck before you see it. 3. The automated collection system, AACS. Once your case moves to AACS, you are no longer dealing with a person. You are dealing with an algorithm. Data matching: the IRS computers cross-reference your social security number with every bank, employer, and brokerage firm in the country. Third-party contact: the IRS can contact your neighbors, your boss, or your bank to locate assets or verify your lifestyle. 4. The 10-year clock. Said. The IRS generally has 10 years from the date of assessment when they officially recorded your debt. How to avoid late filing penalties. 1. File a tax extension form. FARS N 868. Gives you 6 extra months to file. Does not extend time to pay. Reduces late filing penalty. 2. Pay what you can. Even partial payment. Reduces penalties. Reduces interest. 3. Set up an IRS payment plan. Monthly installment agreement. Stops aggressive collection. Lowers penalty impact. The strategy of extension. Filing Form 4868 is your best friend if you're disorganized or waiting on documents. The math: the late filing penalty is usually 5% of the unpaid taxes for each month or part of a month that a tax return is late. By filing an extension, you effectively drop that 5% penalty for 6 months. The catch: you still owe the failure to pay penalty. which is only 0.5% per month. It's literally 10 times cheaper to file and not pay than to do neither. 2. Leverage reasonable cause. If you missed the deadline due to circumstances beyond your control, you might qualify for penalty abatement. First time abate. If you have a clean record for the past 3 years, you can often get penalties waived just by asking. Circumstances: this includes natural disasters, serious illness, or the inability to obtain records. Electronic is faster. Always file your extension or return electronically. You get an immediate receipt, which is your get-out-of-jail-free card if the IRS claims they never got it. State versus federal. Don't forget that your state has its own rules. Some states grant automatic extensions if you file a federal one, but others require their own specific form. The April 15th through leave-in with an extension. IRS starts accruing on unpaid balances on the original deadline. Important note: if you are owed a refund, there is actually no penalty for filing late, but the IRS gets to keep your money interest-free until you do. The hidden value of Form 4868 extension. Many people think an extension is a confession that they don't have their act together. In reality, the IRS prefers you file an extension rather than a rushed, inaccurate return. Avoids the failure to file penalty. This is the big penalty. It's 5% per month of the tax due. If you owe $10,000, that's $500 every single month you're late. Filing the extension brings that $500 down to $0 for 6 months. The safe harbor rule: if you pay at least 90% of your actual tax liability by the original deadline, usually April 15th, and file an extension, you may avoid the late payment penalty entirely, though you'll still owe interest on the remaining 10%. 2. Why paying what you can actually works. The IRS calculates interest and penalties based on the remaining balance. It isn't an all-or-nothing system. Interest versus penalty. Interest is currently hovering around 8% annually, compounded daily. The late payment penalty is 0.5% monthly. The math of partial payment: if you owe $5,000 but pay $2,500 on time, you have instantly cut your future penalties and interest in half. Every dollar you send in early acts as a shield against the compounding math of IRS debt. Navigating payment plans. Installment agreements. If you can't pay in full, the IRS offers several escape hatches. Setting these up shows good faith, which stops the IRS from taking more drastic measures like seizing bank accounts or garnishing wages. Short-term payment plan gives you up to 180 days to pay in full. Usually has lower setup fees. Long-term installment agreement, a monthly plan that can last up to 72 months. The low-income benefit: if you fall below certain income levels, the IRS often waives the setup fees for these plans and may even reduce the interest rates. Summary of costs. The late hierarchy. If you find yourself in a bind, follow this priority list to minimize costs. Highest priority: file the return or extension stops. How to remove or reduce penalties. 1. First-time penalty abatement. Very powerful. You may qualify if you filed on time for the past 3 years, no major penalties previously, all required returns filed. Result: IRS may remove all penalties. Many taxpayers never ask for this. 2. Reasonable cause relief. IRS may forgive penalties if you had an serious illness, natural disaster, death in the family, records destroyed. Proof is required. Starting in 2026, the IRS has begun automating parts of the first-time abate process for certain taxpayers, but you should still know how to manually trigger it if the system misses you. 1. First-time penalty abatement FTA. Think of this as your get-out-of-jail-free card. It is an administrative waiver for taxpayers who have a clean record. Applies to failure to file, failure to pay, and failure to deposit payroll penalties. The 3-year rule: you must have a clean compliance history for the 3 years prior to the year you were penalized. Clean means no penalties were assessed or any that were later removed for reasonable cause. Current status: you must be current on your filings, filed all required returns, or have an extension and either have paid or arranged to pay the tax due. The catch: it only applies to one tax period. If you have penalties for 2023, 2024, and 2025, the IRS will only abate the earliest year, 2023. 2. Reasonable cause relief. If you don't qualify for FDA because of a prior penalty, you can still ask for relief by proving you exercised ordinary business care and prudence but were still unable to comply. How to actually request relief. Step 1. The phone call fastest. For smaller penalties, generally under $500, $1,000, call the number on your IRS notice. What to say: I'd like to request a first-time abatement for this penalty based on my clean compliance history. Tip: if they deny you over the phone, don't panic. Ask for a written explanation and move to Step 2. Step 2. Form 843, the paper trail. If the phone agent says no, or if your penalty is large, file Form 843, claim for refund and request for abatement. How to fill it out: check the box for reasonable cause or other for FTA. The letter: attach a concise, one-page letter explaining your situation. Use a timeline of events format to show exactly how the hardship coincided with the tax deadline. Note: even if the penalty is removed, interest is rarely abated. Interest is viewed as a cost of money and usually only gets reduced if the underlying penalty is removed. First-time penalty abatement (FDA). This is an administrative waiver for people who have a clean track record. Starting in the 2026 filing season, the IRS has begun automatically applying FDA to eligible taxpayers. But if you don't see it on your account, you can still request it. Eligibility criteria. The 3-year rule: you must have had no penalties for the 3 tax years prior to the year you are being penalized. Minor penalties that were previously removed for reasonable cause don't count against you. Filing compliance: you must have filed all currently required returns or have a valid extension. Payment compliance: you must have paid or have an active arrangement to pay, like an installment agreement, the underlying tax due. How to request it. Phone call: most FTAs can be handled over the phone. Call the number on your notice. Simply state: I have a clean compliance history for the last 3 years and would like to request a first-time abatement for this penalty. Form 843. If the phone request is denied or the penalty is high dollar, file Form 843. 2. Reasonable cause relief. If you don't qualify for FDA, perhaps you had a penalty 2 years ago, you must prove you had a reasonable cause. The IRS defines this as exercising ordinary business care and prudence but still being unable to meet your obligations. The big 4 reasons and proof required: death, serious illness, or incapacitation. Applies if you are an immediate. Common mistakes people make: waiting for IRS to contact them, believing small amounts don't matter, ignoring IRS letters, trusting in verified online advice. These mistakes turn small problems into financial disasters. Waiting for the IRS to contact them. Many people realize they've made a mistake on a return or missed a filing deadline but decide to wait and see if they notice. The trap: the IRS has automated systems that cross-reference data like W-2s and 1099s from employers and banks. They will notice. It just takes time. The disaster: by the time the IRS reaches out, months or years may have passed. During that window, failure to pay or failure to file penalties have been compounding. The fix: if you know you messed up, file an amended return Form 1040X immediately. It stops the penalty clock. 2. Believing small amounts don't matter. It's easy to think, it's only a $200 error, they won't bother with me. The trap: the IRS doesn't just want the $200. They want the interest on that money, calculated from the original due date. The disaster: small errors can trigger an automated under-reporter notice. If that small error is part of a pattern, it could trigger a more comprehensive audit of your entire return, uncovering larger issues you weren't even worried about. The math: interest rates for underpayment are adjusted quarterly and can be significant when compounded daily. 3. Ignoring IRS letters. This is the single fastest way to lose control of your bank account. The trap: IRS mail is scary, so people tuck it in a drawer to deal with later. The disaster: most IRS letters have a 30-day window for response or appeal. Once that window closes, you lose your legal right to dispute the amount. This leads to levies seizing your bank account or liens claiming your property. The reality: the IRS is actually quite easy to work with if you respond. They offer payment plans and offer and compromise programs, but only if you're communicating. 4. Trusting and verified online advice. The internet is full of tax hacks that are actually just tax fraud. The trap: social media influencers often suggest that you can write off your lifestyle by calling it a business expense or claiming you're a tax-exempt sovereign citizen. The disaster: the IRS has a specific list of frivolous tax arguments. If you use one, you can face a $5,000 penalty just for filing that way, regardless of how much tax you actually owe. The fix: if it tax tip sounds too good to be true, it's probably illegal. Stick to IRS Gov or a certified public accountant CPA. The golden rule of taxes: the IRS is much more lenient with people who are honest and proactive than with those they have to hunt down. The math of a disaster: penalties versus interest. Most people assume that if they owe $1,000, they just need to pay that $1,000 eventually. But the IRS applies to different fees that work together to bury you. Failure to file: the hammer. This is 5% per month of the unpaid tax. If you wait just 5 months to file, you already owe 25% more than your original bill. Failure to pay: the slow burn. This is 0.5% per month. Interest: this is set by law and changes quarterly. Currently, it's hovering around 8% annually, compounded daily. The result: a $2,000 tax bill ignored for 3 years can easily balloon to over $4,000. You end up paying more in punishment money than the actual tax. 2. The automated under-reporter. Or you might think your return is a needle in a haystack, but the IRS uses a system called Information Returns Processing (IRP). How it works: every W-2, 1099, and even your gambling winnings are sent to the IRS by the payer. They automatically matches these documents to your return. The mismatch: if you forget a $500 freelance gig, the computer spits out a CP 2000 notice. This isn't a human audit. It's an automated bill. The disaster: if you don't respond, the computer assumes you agreed with their often higher calculation and begins. Myth versus facts. Myth: IRS will forget. Fact: IRS has unlimited time to collect. Myth: filing late is worse than paying late. Fact: filing late is far more expensive. IRS myth versus facts. Thinking about ghosting the IRS this year? Think again. Avoiding your taxes won't make them disappear, it just makes them grow. Let's separate the tax myth from the expensive reality. Myth #1. The IRS will eventually forget. The myth: if I just stay off the radar for a few years, the IRS will lose track of my file or move on to bigger fish. The fact: the IRS has a very long memory. The deep dive: while there is technically a 10-year statute of limitations on collecting assessed taxes, that clock doesn't even start until you file. If you never file, the IRS has unlimited time to come after you. They use automated matching systems that flag missing returns years down the line, often hitting you with a bill when you least expect it and with years of interest tacked on. Myth #2. Filing late is worse than paying late. The myth: I don't have the money to pay my tax bill, so there's no point in filing my return until I do. The fact: filing late is actually far more expensive than paying late. The deep dive: the IRS has two main penalties: failure to file and failure to pay. The penalty for not filing is 5% of the unpaid taxes for each month it's late. The penalty for not paying is only 0.5% per month. Math check: that means the penalty for ghosting your paperwork is 10 times higher than simply being short on cash. Even if you can't pay a single cent, filing your return on time stops that 5% failure to file bleed immediately. Myth #3. Only rich people get audited. The myth: I only make $50K a year. The IRS doesn't care about my small mistakes. The fact: the IRS uses automated correspondence audits for everyone. The deep dive: most audits aren't men in suits knocking on your door. They are automated letters generated when your reported numbers don't match 1099 SOW to S sent by your employer. In fact, low to middle income taxpayers claiming specific credits like the IRS statistically flagged more often to verify eligibility. Myth #4. If I didn't get a W-2, I don't owe tax. The myth: my side gig paid me in Venmo/cash/crypto and never sent a form, so that money is invisible. The fact: all worldwide income is taxable regardless of paperwork. The deep dive: whether you're selling crafts on Etsy, driving for a rideshare, or getting paid under the table for landscaping, the law requires you to report it. If you get audited later and the IRS sees deposits in your bank account that weren't reported, they'll assume it's all taxable income and they'll add penalties on top. Myth #5. The IRS told my accountant it was okay. The myth: if my tax preparer makes a mistake or gives me bad advice, they are the ones responsible for the penalties. The fact: you are legally responsible for every number on your return. The deep dive: you sign your return under penalty of perjury. Even if you hired a pro, if they claimed a fake deduction or missed a deadline, you owe the tax, you owe the interest, and you owe the penalty. You can sue a bad accountant later, but the IRS is coming for your bank account first. The closing tip. Host: the IRS isn't looking for perfection, but they are looking for honesty. If you make a mistake, own it and file an amended return Form 1040X as soon as possible. Being proactive is the only way to lower your stress tax. One tax form, one phone call, or one extension can save you thousands of dollars. The IRS is strict, but it also offers legal relief if you act early. Ignoring the problem is always the most expensive option. If you live in the USA, are confused about taxes, received an IRS notice, comment IRS HELP and I'll cover real IRS case studies in the next video.